All right, so this SA tomorrow investment conference 2018 about to get underway. The Master of Ceremonies there.
Minister of Finance earlier on. So if you could please help usher the minister to his seat. Good morning, ladies and gentlemen. Thank you, Disebo, for your enthusiasm. The Honorable Mr. Pravin Gordhan, Minister of Public Enterprise of the Republic of South Africa, Honorable Mr. Tito Mboweni, Finance Minister of the Republic of South Africa, was not in the room at the moment, but he is definitely around the conference vicinity. We will just pause and allow the minister to be ushered to his seat. Minister, that's what you get when you share a table with Mr. Mabuza. He will clap for you when quite clearly all you require is to walk in quietly and take a seat. But who needs enemies when we've got friends like Jabu? Mr. Minister, I've already acknowledged you as well as Minister Gordhan. Mr. Lesicha Khanyahu, Governor of the South African Reserve Bank, who has just walked into the room. Ms. Nonkululeko Nyembezi, Chairman of the Johannesburg Stock Exchange. Distinguished guests, ladies and gentlemen, colleagues and friends, good morning. My name is Kenny Fihla, Chief Executive of Standard Bank's Group Corporate and Investment Bank. I'm honored to be your Master of Ceremony this morning. Welcome to the 6th Annual South Africa Tomorrow Investors Conference, jointly hosted by the Johannesburg Stock Exchange, Old Mutual, UBS, and Standard Bank. Thank you very much indeed for making time to join us this morning. We have a strong group of speakers and panelists today, so I'll try not to take up a lot of your time. This time last year, at this very conference, I stated that South Africa is at the start of a much more positive phase in the political economy and will soon be making much clearer and better policy choices. Ladies and gentlemen, I must confess that even though I was convinced of the country's long-term positive prospects, I was not as confident that the change will happen so rapidly. Our country's democracy and its key institutions proved their strength under severe stress in the past decade. For the first time in South Africa's history, we can now say with absolute confidence that we are a truly mature, rule-bound democracy. Less than a year into the new administration, the new political leadership has made excellent progress in tackling challenges, matters in government, and improving the investment climate. Here are a few of their achievements. A comprehensive judicial commission of inquiry into grand corruption, state capture, as we call it, is underway. The country's commitment to a large-scale renewable program has been reaffirmed, and there have also been far-reaching changes to the boards and senior management of the country's critical state-owned enterprises bringing in rigorous oversight and appropriately qualified management. Arguably, most important of all, we have deeply experienced and widely respected leadership at the Department of Public Enterprise, the Central Bank, and National Treasury. The new administration has been equally energetic in repairing relations with organized business and organized labor. Joint efforts to tackle barriers to investment and develop sectors with growth potential are being undertaken. There are, of course, plenty of other policy and administrative hangovers to deal with. One of these is that several state-owned enterprises remained in very poor financial health, an issue which we will be exploring later. There's also the headline-grabbing issue of land reform. There are fears that this could undermine confidence in the property sector. I think the anxiety is somehow exaggerated. As our recent history has shown, South Africa is not enthralled to big men or to populist gestures. We are a country of constitutional law and democratic due process. I am certain that there will be no state-sponsored land grabs. Having said that, though, South Africa needs a transparent and constructive conversation about all aspects of land ownership and tenure. The issues are pressing and complex and have been fast and delayed for far too long. The current consultative process on this matter is being guided by some of South Africa's best legal minds and leading agricultural experts. Far from being a source of anxiety to investors, we should be reassured that South Africa is finally on track to develop an approach to land reform that addresses the concerns of those who own land and those who are landless, to enable the country to move forward as a more inclusive society. Last year, I ended by saying, buy now while South African assets are cheap. This year, I repeat that message, but with a warning. Be quick, they won't be cheap for much longer. Thank you. Ladies and gentlemen, it is now my great pleasure to introduce Ms. Nonkululeko Nyembezi, Chairman of the Johannesburg Stock Exchange. Ms. Nyembezi has been Chairman of the JSE since 2014, having been a member of the JSE board since 2009. I see the governor is worried about the use of the term chairman. Ngu is also chairman, governor, of the insurer and asset manager Alexander Forbes, and CEO of Eco Capital, or Eco Coal rather, an international mineral resources company focusing on coal mining in South Africa. Ngu, I gladly surrender the microphone to you.
Introduction. He's been doing this for a while now, so it's getting quite practiced, but it hasn't quite reached the level of Sim Shabalala. When it does, I'll let you know. Let me echo his warm welcome to a room that is now quite pleasingly full. When we start this conference, every year this happens, in the first couple of minutes just before 10, the room is empty, and you start to think, oh dear, did we just bring South Africans here? I mean, we could have had the conversation at home, and then all of a sudden everybody crowds in. So a grand turnout. Thank you all for joining us yet again. You heard Kenny talk about the governor. Actually, what he was talking about right that moment was our Minister of Finance. So now let me take the opportunity as well to welcome Minister Tito Mboweni to his first outing on this particular gig, because he has just recently been made Minister of Finance, but of course is known, I'm sure, to many people in the room, having been Governor of the Central Bank for a long time. I also want to welcome Mr. Lesetja Kganyago, who's our very capable leader of the South African Reserve Bank at the moment. But really, this is an opportunity for me to welcome our distinguished guests who've come to join the South African colleagues who've flown out here to come and meet with you during the course of the next 2 days. It's really an honor to see so many of you. Let me start by just reiterating that the Johannesburg Stock Exchange takes its responsibility to build better markets very, very seriously. As a highly regarded listing and capital raising venue, we are proud to have garnered this year the Groundbreaker Award from the UNDP's Sustainable Stock Exchange Initiative, which essentially to us is a recognition of over a decade of thought leadership in this particular space. Not only does it attest to the exchange's ability to adhere to its own strict listing requirements, but it speaks volumes of the role we have continuously tried to play and continue to play in advancing South Africa's progressive business practices through thought leadership in sustainability and governance. It is true that in the past year, we've had serious challenges in this regard. We've had our fair share of corporate scandals, some grand, some not so grand. And at such times, we do get tested. And hopefully those who follow this particular story would have seen just how robustly we have reacted to address all of those challenges. We believe we are on track to build a world-class market infrastructure through various initiatives, and the very latest one was just in this past year, where we have launched an electronic trading platform for government bonds, done together with the multiplicity of participants and stakeholders in the bond market, but most notably, National Treasury. Clearly, everybody in the room knows just what a rough period emerging markets have experienced this year, been buffeted by a multiplicity of negative developments, most notably the trade tariffs imposed by the US on China and a few other countries. Given the nature and profile of our economy, we have not been spared as a direct consequence of this and have had a fair share of negative impacts from this. But it's also true that there have been many country-specific factors that have contributed to economic growth substantially lowering this year to the point where in third quarter we experienced a technical recession. GDP growth for 2018 is currently estimated at 0.8%. But there has been a positive side this year in the significant progress that we have made on the political front. Political climate in South Africa turned sharply positive in February after a change in political leadership that we experienced at that time, with a knock-on impact on business confidence. Now, if you know anything at all about South Africa, is that we don't really, as a society, have middle ground. We don't understand the concept of equilibrium. We're either suicidal or euphoric. So at that point, and it could actually happen in a single day, but let's just stay with it. So we swung to this rather euphoric national mood, which was enjoyable. It reminded us of the hope that we had in 1994, of the nation-building event of 2010, and that we still had it within our society to push forward, particularly in collaboration with all sectors of society. According to the South African Chamber of Commerce, economic growth is set to strengthen in 2019, driven in the main by this improving trend in business and consumer confidence. Clearly, employment trends remain a concern, but GDP growth strengthening into the outer years is a very positive indicator that we might start eating into that as well, with it being expected to recover gradually by 2020, 2021 to 2% plus, but I'm sure Lesetja will speak a lot more on this issue. Two years ago when we came to this conference, we touted what was then a coming together of business, government, and the Labour front, and making it clear that we do believe that in the way of moving forward, there needs to be tighter collaboration, but particularly between government and business. It is fair to state that this has accelerated even further in this past year, and it is becoming visible that we have a political leadership today that is keenly aware that this is going to be a source of progress, and that it is actually not going to be possible to make progress without strengthening this interface and this working together. Bodes well for the future as we jointly tackle what we believe to be our triple challenge of reducing poverty, unemployment, and inequality in our society. We welcome President Cyril Ramaphosa's recently announced economic stimulus package. While we acknowledge that this is just a start and the important work is going to be done to revive our economy, this being the most industrialized economy in Africa. But we do believe that the implementation of this, handled, as I said, together between government and business, is what will unlock the potential in our country, which Kenny told you is now well on the way, and we expect to see rapid results as we move forward. Naturally, this does need to be coupled with the sort of legislative and regulatory environment that fosters business confidence and, in particular, foreign investor confidence. Again, I have to say, after coming out of last week's inaugural Presidential Investment Conference, it is very clear that we have a political leadership that understands its role in making certain that the regulatory regime is as business-friendly and investor-friendly as it can possibly be. Given our history, you would understand that empowerment, what we term empowerment, you could call it transformation, whatever term people are comfortable with, but this has to be an important cornerstone of absolutely everything we do. We make no apology for this because it does need to be tackled and addressed over time. As a consequence, this issue has become the backbone of most of policy and legislation for the past 2 decades. With the uncertainty and volatility that came with the third draft of the mining charter, we are pleased today that we've actually gone a little bit further in that space with the recent draft of the mining charter. Again, this will be a topic that will be elaborated further during the course of this conference. Against the context of a young population coupled with high levels of unemployment, particularly youth unemployment, it is vital that this is the one part of our society that receives continuous and urgent attention, and really, again, a collaborative effort to find solutions that would yield long-term benefits to solve this particularly intricate and intractable problem. In the medium term, government has committed to set aside some 60 billion rand, $4 billion or so, in revenue from the skills development levy to expand participation in learnerships, in internships, and skills development programs, which is squarely focused at this particular demographic. I want to conclude by just sharing with you that the President earlier on in the year announced that he was putting out a challenge, and this challenge was to secure $100 billion in inward investment in South Africa, both by domestic business and foreign business, and appointed 4 envoys, some of whom are in the room today, to drive this particularly, I should say, ambitious initiative. I don't know how many business people actually believed these numbers when they were announced. But last week, it was announced that already $35 billion in commitments have been secured towards this target. And so suddenly it doesn't look barking mad as it might have done to people right at the start. So we are on the march, and we think that we have identified the key matters of state that need to be addressed to get the economy moving forward. The various discussions at this conference will allow the investment community invaluable insights into the various plans and implementations that are being done across a raft of areas, most notably the state-owned enterprise and the restructuring that is going on in that sector. The role of business in managing that particular deliverable also needs to be clarified, and I think will become clear during the course of the day. and also how local business in South Africa is navigating all of these key policy issues that Kenny touched on, such as the land question. As always, we build this investment conference more as a platform for a conversation, and we have never gone away disappointed by the level of interest, by the probing questions that come from the American audience. We certainly hope that this will be the case again today, and so it just is now for me to wish you a productive engagement. Thank you.
Well, thank you very much, Nku. As usual, quite insightful and very precise. And my ambition is to be like you, not like Sim. So I think it's a much more higher ambition. It is now my honor to call upon the Minister of Finance, the Honorable Tito Mboweni, to address us. Minister Mboweni was appointed Minister of Finance just 3 weeks ago and has delivered his maiden medium-term budget policy statement under challenging economic circumstances to wide acclaim for its candor and reasoned optimism. The speech powerfully demonstrated that South Africa has returned to policymaking that led to our years of fast growth and development. Looking at the details, I was particularly encouraged by the fact that the expenditure ceiling remains intact, by the firm commitment to end the expansion of the public sector wage bill, and by the minister's statement that, I quote, reconfiguring our state-owned companies requires us to take a hard look at how they operate. Our current challenges with state-owned companies present an opportunity to demolish the walls that exist between the private sector and public sector, close quote. As most people here will know, Minister Mboweni is very far from a newcomer to South African policy making, having served as deputy head of the ANC's economic policy team, as Minister of Labour in President Mandela's administration, and for a decade, and with immense distinction, as Governor of the South African Reserve Bank. Mr. Minister, thank you very much for making time to be with us this morning. Please, may I hand over the podium to you.
You know, he hasn't changed much from the days when he used to be an activist, leading the ANC in Johannesburg. But he never became a mayor of Johannesburg, despite all valiant efforts. And he retreated to banking. Colleagues, Minister Gordhan, there's a correct pronunciation of his name, Gordhan, not Gordon. Gordhan, which means the shepherd. Minister Manuel, everybody else. Apparently in Africa they say that once a minister, always a minister. Now he masquerades as a chairman of companies, but he's a minister. I'm very pleased to be back here to interact with those of you who have an interest in the South African economy, our trials and tribulations. I particularly welcome those who always take the correct position in the market when we are in trouble. So it's really good to see you. So let's just walk with me on this very short journey, and let's see where we'll end. Last week we presented the medium-term budget statement. against the backdrop of a slowing South African economy in a technical recession, which means by definition our revenue collection would suffer. By logical extension, therefore, it means that our spending plans will also be affected, and we have to revise our ambitions downwards. Against the background of a persistently high wage bill in the public sector, which means that if we are not careful, a greater amount of our budget will be consumed by the public sector wage bill. Against the background of state-owned enterprises which are struggling in many ways, and the minister is here to talk about that. Against the background of global trade wars started by some people who live in the city, which is not very helpful to global economic performance. Yet, part of the background of this walk I'm taking with you is not as bad as it sounds. We have inflation still contained within the inflation target band of 6 to 3%. I always wanted to emphasize the downward trend, not 3 to 6, because it looks it's going up, we want it to go down. An independent central bank which operates without fear or favor, despite attempts from time to time by the uninformed to interfere with the bank. At least now he has an ally. Yeah. We'll try and maintain the dikes so that the water doesn't destroy anything. Now, the Minister of Mines has come to the party and begun to indicate positive signals. That's good. Minister of Public Enterprises has begun the reform process of the state-owned enterprises, good part of the journey. The President has appointed his presidential envoys for investment, very good. So there are many other good things along this path that we are walking. So, what to do? The question that arises is, where is the growth going to come from in South Africa? Against this difficult background that I've just sketched on this journey. Probably from two parts. Firstly, the investment drive that we have embarked upon. Once we're clear which sectors and subsectors this investment drive will affect, there's no point, Minister, saying there's $200 billion of investment going where? In which specific sector and subsector? That's what we're interested in, not the macro figure. Macro figure is nice for the governor and myself, but the specific sectors and subsector. And I think that's what the investment envoys are going to discuss with you later today. So I think that we should help generate some growth. Secondly, the infrastructure drive that we want to promote should help generate some growth. The kind of infrastructure drive that characterized the mood in South Africa pre-2010, that's what we need. Do we have what it takes to achieve that? The answer is yes, we do. And if we continue working together, we can indeed begin to see the green shoots of growth and later some better performance of growth. I was told that there will be a Q&A, so my journey ends here with these positive possibilities. The rest of the issues you read in my budget statement, but we need to look forward now to what is achievable. With those few remarks, I thank you very much. I'll be taking some questions, I understand. Thank you very much. Do I stay here?
Minister, thank you very much. May I suggest, Minister, that we probably detain you for a little bit longer here at the podium for the Q&A. This is a very kind detention.
Okay.
In case I scared you. Ladies and gentlemen, can be brought to you. There's a hand here. And just introduce yourself and please ask a brief question. Minister, how many questions should we take?
Three
per round? Three per round? Okay,
Yeah.
we'll take 3 questions.
Minister, thank you very much for taking questions this morning. My name is Meral Kreslo. I work for Oppenheimer Funds, and we are keen investors in your debt markets. My question relates, unfortunately, again to the medium budget that you presented, and also some of the very bold statements that were attached to it, such as your comments with regards to the wage bill, recognizing the issues with public wage bill. One interesting thing in the medium-term budget was that you kept that line constant despite the agreement that has been signed previous you taking this ministerial seat. How are you going to achieve that line being kept constant, and what shall we expect going forward, especially in light of the upcoming elections?
Can we have the second question, if there's any?
Oh, there isn't. That's wonderful.
Minister, should we ask you to deal with that question whilst the audience is
No, there isn't
some
another
courage?
question. I think that's very nice. I think the approach that we have taken is that this continuously increasing pressure on the public sector wages is not good for the country. Public sector wages, I think, account for about 35% of the budget. That's quite large. So when we talk about reconfiguration, we mean that we must find some creative ways to deal with this wage bill. Amongst other things, it means, for example, that people retire. So, you know, every year so many people are going to retire. I don't have the numbers with me. So if the posts are not that critical, you don't recruit new people to fill the numbers, but you promote within your pipeline to occupy those positions. It's another way to deal with it. I'm sorry to say people die as well. Even civil servants die every year. So it affords you the opportunity to reduce the numbers and so on. I'm not wishing anybody death, but it happens. So there's a way of keeping the bill, the wage bill flat. But also departments have to find a way to reprioritize within their budgets. My observation so far is that there are many instances where departments actually don't spend what they have. And we have said that, provinces, national government as well must find a way to reprioritize. And there's a lot of screaming and shouting about it, but we don't hear it. We hear the noise, but we're not listening, because if you listen too much, like I must tell you, there was one municipality which last week was crying foul that they lost money in a bank called VBS, and therefore they were unable to pay salaries last week. And then they phoned me to say, can you allow us to pay salaries from our share of the equitable grant next year? So you want to take next year's money to pay last week's salaries? I said, well, you'll have to come and fetch me from a mental hospital to agree to that. Because I couldn't agree to that. I said, no. So there are ways. You just have to stay firm with this situation, become equally as unpopular as Trevor Manya. That's what you have to do, to keep the ceiling. Otherwise, you can lose control. But I don't want to lose as much hair as him, though.
Thank you, Minister. Can we get another set of questions? There's a question right at the back of the room.
Thank you, Minister, for your remarks. I'm Puneet Pujara from Autonomy Capital. I have a two-part question in terms of the challenges that South Africa faces. One more short-term, upcoming budget in February. You're facing elections in a couple of months, and how are you going to balance, the political realities with the financial realities, of the country, and longer term. What are the ways you're thinking about, bailing out the SOEs or helping them out? I mean, this is just a problem, being, pushed out in future. Is there a plan from the finance ministry side on it? Thank you.
Let me start with the publicly owned companies, and I think Minister Gordhan will deal with this in detail. In the budget speech, we mentioned that there should be no holy cows when we reconfigure these publicly owned companies. I know he won't like me saying this, but let me say it nevertheless. So we have South African Airways, well-known South African airline, which has the marginal propensity to lose money. And therefore tends to approach the government on a regular basis for support. South African Airways also owns a percentage, about 1.7% thereabout, of 5%, 3% of Airlink, which seems to be making a bit of money, the Airlink company. South African Airways also owns 100% of South African Express, which is kind of the feeder airline. South African Airways has major onerous legacy contracts with suppliers, but also has some very bad management things. The simple thing, for example, I understand, Minister Gordhan, that there are people who manufacture and sell airline tires. So there's a tendency not to buy directly, but to go via an agent. So the agent has for many years been receiving a commission for selling tires to South African Airways. And the agent is going nowhere because that's their livelihood. Even the ones that supply with cheese and biscuits in the plane, onerous contracts, pilots, have onerous contracts with South African Airways. I'm told on a particular day, I won't mention the percentage, but X percentage of the employees of South African Airways are on sick leave. But if you go home, you find them doing the gardening. They're not sick. But it's ingrained in the culture of the organization. It's loss-making. It's very clear to me that you are unlikely to sort out the situation. So my view will be close it down. Close it down. We have the case study of Swiss Air, which had to close down, and you start a new airline. Altogether, invite Sim Shabalala and others to come together, syndicate, and form a new airline. The only thing we might request is that give us the colors, like British Airways. So you say you want to fly the national colors, fine. You can fly it, but you don't have to own this thing that we can run. I leave that problem with Minister Gordhan. And they're going to be asking him to clarify this statement. The thing I say, why I say close it down is because you will not, it's unlikely that you're going to find any private sector partner, equity partner, who will come and join this asset. If there are any one of you who want that, please talk to us. Because so reconfiguring means, for example, that in all sorts of assets that we own as a state, we're prepared to have private sector partners that we can work with. That's part of the reconfiguration. But there's something that Minister Manuel will agree with me that I think is a failure on our part, which we need to correct. In 1994, we went into government together. One of the first things that we did was to ask for an audit of state-owned assets, 1994. And we said, in this audit, let's identify core and non-core assets. 1994. So I come back into government in 2018, and I hear the same thing. So I say, I now believe in reincarnation. It's really true, this thing. Because in 1994, we talked about the same thing. In 2018, the same thing. So, but I want to promise you that next year, when we have this conversation, we'll no longer be talking about a list of assets and so on. We'll not be talking about we are going to reconfigure. We need to be able to demonstrate we have reconfigured this one and that one and that one. That's the way to go. Otherwise, we're wasting our time and wasting your time and your expenses coming here. So we'll do something about this. The first question had to do with what you do in a tough budget situation approaching elections. Well, one of the things that we have learned over the years is that there is a tendency indeed by governments to loosen the purse as they approach the elections. And more often than not, this has taken the form of special allocations for civil servants. In Ghana, for example, oops, there's nobody from Ghana here. In Ghana, for example, if you look at the Ghana fiscal position, just before the elections, there's a sharp increase in salaries. Then it gets quiet for 4 years. Next election, sharp increase, and so on. We're not going to do that kind of thing. A government must be judged not what they've done 3 months before an election, but what they've done for 5 years. That's what matters. Fortunately, I can say I was not there. I can say that.
We've got time for one more question, if there's any from... I think the lights are a bit blinding, so if you see are struggling to see you, especially if you're closer to these big flashlights, please bear with us.
Minister, thank you very much for your presentation. I'm here on behalf of the International Trademark Association. we deal mainly with intellectual property and trademark issues. I know it's not directly related to your portfolio, but it's somehow related to investment. A couple of months ago, we are happy to see that, the South African government, had adopted the intellectual property policy phase 1. So that's a good step, especially for us, we deal with trademark and IP policy. We have a couple of members, most of our members are based in South Africa. So, but recently we saw that from the Department of Health, which is considering to adopt what we call a brand restriction policy, in the sense that, let's say that we go to a supermarket, we cannot make a difference between a product, whether it's Coca-Cola or Pepsi-Cola or a Ford or a Mercedes, so on and so forth. So from a trademark perspective, it's a bit, a concern. Because why? I think it contributes to increase, counterfeit goods. And we know also the link between counterfeit goods and national security. Yes. So to make it short, we would like to know where is the government going? Because when we look at the IP policy, which is more balanced, and we look at the recent development, is not really the case. So we are a bit out there, and we really don't know.
Okay.
Thank you very much, Minister.
No, thank you very much. I know nothing about that, though. But what I can promise you is that we'll speak to the Minister of Health. We'll say, Minister, let's focus on the key strategic issues that are confronting the country. Now, what about this thing, whether this is a correct cigarette label or this? Let's make the hospitals to function. Leave these things aside. Focus on the key strategic issues. Yeah? That the doctors are there, in the hospital, they're working, that the patients have got beds and linen. That's the most important thing that the Minister of Health should focus on, not on the label of a cigarette box, really, truly speaking. So, but we'll speak to the Minister about this. I'll explain to him what you said to me and let him focus really on the strategic issues confronting our people, not these marginal issues. Well, but I need to come back to, I need to come back to the issue of the reconfiguration of state assets again, because the chairman of ESCOM is here. Because if we're serious about attracting investment, we also need to think very seriously out of the box. For example, there's nothing God-given that says that ESCOM must be involved in the whole value chain in the electricity production. Generation, transmission, distribution. It's nothing like, there's no God-given thing like that. So we have to think very seriously about a reconfiguration of ESCOM such that probably we need to separate the transmission from the generation in a very serious way, so that we can form a national grid company that's responsible for the national grid, managing it, and then on the other hand, have a series of power producers, which will include ESCOM, but there will be others as well. And I think we need to think about that. The distribution model, I know nothing about, but I know, and Trevor Manuel will remember this, somewhere in 95, 96, we discussed something called the REDS. That's in the 90s. 2018, still talking about the same thing. So there needs to be some movement, and I think what needs to characterize the Ramaphosa administration is the speed with which we move and implement things, so that we don't behave like crab. You know, a crab thinks it's going forward, but actually it's going sideways all the time. So we don't want to move like crabs. We want to go forward. Thank you very much. Thank you.
Minister, thank you very much. Thank you. Minister, thank you very much for, as always, your candor and the frankness with which you dealt with the questions that have been raised from the audience. Now, ladies and gentlemen, it is my honor to introduce our next speaker, the Governor of the South African Reserve Bank, Mr. Lesetja Kganyago. Governor Kganyago was appointed Governor of the South African Reserve Bank in 2014, having previously served as Deputy Governor from 2011. Under Governor Kganyago, the Reserve Bank has faced serious economic and political challenges and has firmly maintained its credibility as the defender of price stability, enabler of inclusive growth, and bulwark of our financial system. We are proud of the excellent work that the central bank has been doing over the last couple of years and continues to do to this day. Mr. Governor, could I please call on you to come to the podium?
Thanks, Kenny. I'm increasingly becoming a veteran of this conference myself. Thank you, Minister Mboweni. It's good to have you back. Once a central banker, always a central banker. And it is good that you had taken such a tough stance against people who talk things about central banking that they do not seem to fully comprehend. So I will return the favor. Good morning, ladies and gentlemen, and thank you very much for the opportunity to share a few thoughts with you today. Last year, we had a Goldilocks global economy. Inflation was higher in the advanced economies, but not too high. And in the emerging markets, it was generally in line with targets. Growth was stronger, but without much evidence of overheating. Growth was also widely shared. Most economies were accelerating. The world economy felt just right. As you know, at the end of the Goldilocks story, a family of bears comes home. Our Goldilocks tale has taken the same direction. The synchronization of global growth has broken down this year, with the United States surging ahead whilst other countries slow down. With unemployment at very low levels, the Federal Reserve has been raising rates just as they told us they would. The combination of stronger US growth and higher rates has appreciated the dollar. This combination of factors has posed challenges for the emerging markets. It has interrupted capital flows and prompted wide-scale currency depreciation. Countries with substantial stocks of foreign currency debt have seen their balance sheets deteriorate. Inflation pressures have generally intensified. Unlike Goldilocks, however, most of us in the emerging markets weren't caught napping when the bears showed up. We had frameworks in place to handle such challenges. In particular, most of us could rely on flexible exchange rates to absorb the initial shock. This works best when countries have avoided contracting excessive foreign currency debt, as in the South African case. In these circumstances, the best thing we can do is to leave the foreign exchange markets to find a new equilibrium. Of course, currency depreciation creates inflation pressures, but a wide range of emerging markets has strong central banks who can deal with the problem. Given the credibility accumulated by these institutions, inflation expectations have stayed anchored in most emerging markets. Emerging markets have also been buffered by substantial stock of foreign exchange reserves. It is clear that most emerging markets are vastly better positioned than they were during the 1997-1998 crisis. Certainly, a few countries have been sorely tested by events this year, and the International Monetary Fund has been called into action on several fronts. Most emerging markets, however, should be able to get through without experiencing financial crises or crippling sudden stops. The most difficult question is this: how will countries adjust the ever-changing global circumstances, and what does this mean for their growth and development trajectories? Let me set some few problems. First, a number of countries are running sizable deficits on their fiscal and current accounts. Countries with larger deficits have tended to experience more currency depreciation this year, which speaks to their vulnerability to changing global conditions, especially higher interest rates. Reducing this vulnerability will require deficit reduction, as well as changes in the composition of spending that benefit long-run growth and therefore improve countries' future capacity to pay. This adjustment process is likely to be difficult, both for political economy reasons and because macroeconomic adjustments can hurt short-term growth, specifically via reduced demand or through import compression. But what can't go on doesn't go on. We just have to figure out the rebalancing process. Second, there is a range of prominent emerging markets where growth has stalled. Looking back over the past 2 decades, the 2000s were an era of unprecedented growth for emerging markets. The share of economies converging on rich country living standards also reached new highs, demonstrating that this was more than simply a China story or an India story, important though those countries are. This record of success survived the global financial crisis, but only for a few years. From approximately 2013, emerging markets began to slow steadily, and some experienced protracted recessions. Outside of Asia, the emerging market story is now largely about subdued growth, and some countries are talking about lost decades. We need to find a way back to growth. The third problem follows when politics catch up with economics. In advanced economies and in emerging markets alike, dissatisfaction with economic outcomes has generated political developments that could have been very unlikely, if not unthinkable, even a decade ago. Sometimes, these reactions have made things worse or threatened to do so, creating a vicious cycle of bad economic decisions and further political dissatisfaction. These problems, macroeconomic disequilibria, stalled growth, and political feedback loops add up to a difficult set of circumstances for the emerging markets. Today, I would like to talk about how we might navigate them. Given my brief, I am going to focus on South Africa's experience and outlook, although I think that this framework is useful for thinking through the broader emerging market challenges. Since the 2013 taper tantrum, South Africa has undergone a substantial macroeconomic adjustments. In particular, the current account deficit has narrowed from nearly 6% of gross domestic product in 2013 to 2.4% last year. This change came largely from the trade account, which has registered surpluses in 8 of the past 10 quarters. Our services account has followed a similar trend and is now roughly balanced. By contrast, our income and current transfers account has remained in deficit. This is in part because of transfers to our neighbors in the Southern African Customs Union, amounting to roughly 1% of GDP annually. The balance reflects income payments driven by high yield differentials on our foreign liabilities when compared with our foreign assets. A growing stock of sovereign debt held by foreigners has been an especially important contributor to these income payments. The overall income deficit stands at about 3% of GDP, of which close to 1.5 percentage points is coming from interest payments or on sovereign debt. The fiscal balance has changed less than the current account deficit, at least at a headline level. The latest medium-term budget policy statement indicates a fiscal deficit of 4% of GDP for 2017-2018 financial year. This is better than the 2012-2013 figure of 5%, but is still relatively large, both in absolute terms and relative to previous projections. The change in the primary balance has been more dramatic, narrowing from a deficit of 2.3% of GDP in 2013 to 1% in the latest financial year. But this number is still negative, so the debt stock is not yet stabilizing. As a central banker, I try not to say too much about fiscal policy, not least because I would like to reciprocate the courtesy that the other authorities show us by respecting the independence of monetary policy. Let me therefore just reiterate 3 crucial points made by our Minister of Finance, Mr. Tito Mboweni, in his recent address to Parliament. To quote directly, we must choose a path that stabilizes and reduces the national debt. We cannot continue to borrow at this rate. We must choose to reduce the structural deficit, especially the consistently high growth in the real public sector wage bill. New fiscal anchors may be required to ensure sustainability in addition to the expenditure ceiling. We must choose public sector investment over consumption. Welcome back, Minister Mboweni. This is an extremely clear statement of intent to improve the fiscal balance and to do so in a way that favors investment and is therefore good for long-term growth. We are clearly well past the point where we could hope to crowd in investment simply by raising spending and boosting demand. With rising long-term interest rates globally, previous credit rating downgrades and tax increases, the case for fiscal stimulus based purely on spending aggregates is well past its sell-by date. Government cannot keep on de-saving. That is what Tito Mboweni told South Africans. Ultimately, South Africa remains a low-saving economy. We can improve savings rates, especially through fiscal policy. But we are not going to be a high-saving country for the foreseeable future. For this reason, we need to get to a position where we can safely and sustainably fund investment demand in excess of local savings. Instead of bemoaning a weak current account, we need to develop a strong capital account. Getting there is likely to require capital inflows into equities and direct investment and less into government bonds. One attraction of these investments is that when growth weakens, profits decline and outflows diminish, which keeps the current account under control in low points of the business cycle. Another perhaps more critical advantage is that these kinds of inflows help growth. Attracting investments of this nature is central to the President's growth vision, as was articulated most recently at the investment summit he had convened last week in Johannesburg. Reducing government's appetite for borrowing is a priority for our new Minister of Finance. To sum up this discussion, South Africa is still a country with significant twin deficits. They are smaller than they were in 2013, but they are still relatively large. Their scale is a source of vulnerability, as is their composition. But we are less vulnerable now than we were in 2013, meaning we are better positioned to absorb the shocks from the international movements. Going forward, we need to reduce our fiscal deficits and we need to ensure that our borrowing is more productive. We are not saying we need to keep our current account deficit as small as possible. One does not come to an investor conference in New York to say that capital flows are a source of vulnerability and that we don't want them. If I believed that, I wouldn't need to be here. Rather, we want to get to a position of capital account strength in which South Africa attracts investment because it has good growth prospects and because it provides an institutional environment that gives investors security and predictability. South Africa's economy is likely to grow by just 0.7% this year. Earlier in the year, we expected growth to be meaningfully stronger. Our March forecast was for 1.7% growth, and our assessment was that the risks to this forecast were to the upside. In the short term, those hopes have been disappointed. More fundamentally, 2018 is likely to be our 5th consecutive year of negative per capita growth, given population growth of about 1.6%. These sorts of growth rates are well below our longer run average of 3% or so, let alone the rates of above 5% targeted by the National Development Plan. Some of the blame for this weak growth can probably be attributed to global factors, including the declines in commodity prices and weak growth in our traditional trading partners. However, domestic growth has remained subdued despite a cyclical upturn in the global economy. The South African economy has also failed to accelerate despite a large improvement in our terms of trade, which reached an all-time high late last year. This suggests that causes of weak growth are chiefly domestic in nature. Some degree of blame attaches to shocks like drought or strikes in specific sectors, but this cannot explain why growth has stayed low for several years. Instead, the primary cause of weak growth has been the severe decline in South African governance in recent years. A period of decay which is only now coming to an end. This episode, known throughout South Africa as state capture, involved hollowing out of institutions and in many cases, the looting of public resources for private gain. One of the many consequences was a large decline in business and consumer confidence. This in turn has contributed to investment stagnating over the past 5 years. State capture has also been a major factor in our fiscal woes, both because it burdened the state with corrupt and fruitless expenditure, and also because it is seriously undermining the capacity to collect taxes. There are several reasons to expect better growth over the medium term. One is the backlog of investment I have just referred to. Our investment levels are now under 20% of GDP, and it would make sense for firms to begin investing more. In the first instance, simply to catch up with depreciation, now that the domestic environment has improved. A second pro-growth factor is better household balance sheets. Unlike its emerging market peers, but like many advanced economies, South Africa had a housing boom in the mid-2000s. It has left households carrying a large debt burden, a burden which has been weighing on their ability to consume. However, households have achieved significant deleveraging since then, and the debt-to-income ratios are now back to the levels last seen in 2006 and closer to their long-term averages. Although it is very important to specify when we will pass the tipping point, we are probably close to or even at the end of the deleveraging cycle, meaning households will have better capacity to take advantage of the resurgence in growth. A third factor favoring growth is the scope for further reform. We have already seen a great deal of energy and initiative from government around key issues such as raising employment and investment. As an economy, we are still a long way from the efficiency frontier in a range of areas. Perhaps our network sectors most of all. This, to mix metaphors, leaves an impressive amount of low-hanging fruit available should we develop an interest in picking it. This brings me to my third and final topic, the interaction of politics and economics. As you all know, forecasting economic events is hard, but predicting the interactions between political and economic events is all but impossible. Once something has already happened, we are all quite good at stitching together a casual narrative that makes that outcome seem inevitable. Certainly, our ability to explain the past is much stronger than our capacity to prophesy the future. One of the great challenges is guessing what will happen politically when a country's growth stalls. South African Reserve Bank employs a lot of very competent economists. They are not political analysts, so don't ask me where the politics are going. The ministers are here, they can tell you where the politics are going. A plausible outcome in this discourse is that bad economic performance and all that it entails will produce a populist rejection of incumbent elites and policies. Another plausible outcome is that bad economic performance will empower the reformers already in government who are therefore known quantities. This seems to be the way South Africa is going. Of course, we too have a share of populists who want to do radical things, but it is increasingly clear that the center in South Africa will hold. We have strong institutions and we have the better arguments. We cannot stop some people from saying populist things, but we can win the policy debates, and we are winning. Bad economic outcomes in this case seem to be supporting better policies in South Africa. To conclude, this is a difficult moment for emerging markets. After a long run of success, we are now confronting a range of serious challenges, including excessive macroeconomic imbalances, stalled growth, and difficult politics. As all of you will know, from your years of experience investing in emerging markets, the asset class is marked by volatility. You are here because the returns can be high. But you also acknowledge that there can be low moments. Had you been more risk averse, you would have the good returns emerging markets offered being missed. In truth, and as has been said in other contexts, we are probably not as good as we look when we are winning, but we are also not as bad as we seem when we are losing. The past few years have been difficult ones for South Africa, as for many other emerging markets, but there is a respectable case to be made that things will get substantially better. We can achieve macroeconomic balancing that favors investment and growth. We aspire to growth rates nearer our historic levels, and once we achieve that, we can get ambitious about faster growth rates. We are recovering from a period of self-inflicted injuries, and there are good growth opportunities that we can exploit when we have recovered our health. Our politics have taken a reform path. We should permit a constructive response rather than a destructive reaction to the disappointments of the recent past. I am confident that South Africa tomorrow will be better than South Africa today. Thank you.
Governor, thank you very much for a very punchy presentation, rich in content, and yet extremely positive in terms of its outlook for the future for the South African economy. Ladies and gentlemen, the governor has also agreed to take a few questions. We will follow a similar pattern to the one that we followed with the minister, and that will attempt to take 3 questions at a time and see how that flows. Are there any questions for the governor? Please raise your hands, and there are roving mics. They'll be brought to you. Introduce yourself briefly and state the question. Governor, if I may sort of kick off with a question. What are the possible consequences for monetary policy of a rising global bond yield cycle, especially if viewed within the context or is coupled with the trade tensions between the US and China?
You have kicked off. Can the ball play?
Well, Governor, if you could take that question, and we'll follow with other questions after that.
Bond yields had to go up at some stage. Bond yields declined as the advanced economies embarked on unconventional monetary policies and purchased domestic bonds in their respective jurisdictions. And in theory, the money was supposed to stay in the developed economies and thus spare consumption in those countries. Well, there was a big leakage because capital is highly mobile, and what the money simply did was...
All right, well, there you have it. Live visuals coming out over the 2018 SA Tomorrow conference taking place in New York. We've heard numerous speakers speaking, of course, the Finance Minister, the Reserve Bank Governor, Lesetja Kganyago, who was taking questions now. And the overall sense that you're getting from the speakers is there is now hope in South Africa. Come invest in South Africa. There is change in leadership, so things look bright.
You're absolutely right.
The first channel was that when policy normalizes in the advanced economies, the spread
coming through.